Hello, everyone. Welcome back to our Wealth Planning 101 video series. My name is Spencer Borschelt.
And I'm Elizabeth Burdett. In this video, we'll give you an overview of the various types of taxes and some basic tax concepts. We'll also highlight some tax benefits of charitable giving and provide you with some strategies for aligning your donations with the causes you care about.
To begin, we'll start with an overview of the different types of taxes. Taxes come in many forms: income taxes, capital gains tax, corporate tax, FICA tax, real estate taxes, personal property taxes, sales tax, and estate tax. I know I'm probably missing a few, and maybe more than a few. While the goal of this segment is not to make you a CPA, our aim is just to give you more of a general understanding of personal taxes. In general, the more you make, the higher the rate, but only on dollars above the limit. This chart shows the 2023 tax ranges from 10% all the way through to 37%. Most people have already filed their taxes for 2023, so how did the IRS calculate the taxable income? Let's refer to this chart the IRS posted. This chart illustrates a single filer that reported their taxable income as $58,000. Please note that there are other types of taxes or filers subject to different brackets. The first $11,000 earned income is taxed at 10%. Then the next dollar earned above $11,000 through $44,725 is taxed at 12%. Then after $44,725 to $58,000 is taxed at, you guessed it, 22%. So if someone says they're in the 22% tax bracket, that doesn't mean that every dollar was taxed at 22%, but only the dollars that fall in the bracket. So if the amount is $44,726, I have only $1 being taxed at 22%. What about appreciated assets, such as when you own a stock and sell it down the road? Well, if you hold an asset for longer than a year and sell that asset at a value higher than what you paid it for it, then it'll be subject to capital gains tax. This chart shows 2023 long-term capital gains taxes. The highest capital gains rate is much lower than the ordinary income chart we looked at earlier. Reminder, this is for an asset held longer than a year. If you sell an asset at a gain under a year, it's subject to short-term capital gains rates. This would fall under the income tax rate that we viewed earlier. So what are the options the government gives us to reduce potential taxes? Everyone is different, so we recommend consulting with a tax professional to review strategies that fit your needs and circumstances. One of the options the government allows is the ability to save in retirement accounts. This usually allows funds to grow tax-free. But there are two different kinds of options we found are the most common. Traditional retirement accounts, such as 401ks and traditional IRAs. Pre-tax funds go in. This means you have not paid taxes on the earned income yet. Then taxable funds come out. Roth-style accounts, such as Roth IRAs and Roth 401ks. Post-tax funds go in, so you have already paid the taxes. Then tax-free funds come out. Both these options grow tax-free, but on how the money goes in and comes out is different. So what about possibly reducing a tax bill when filing taxes? There's a standard deduction and an itemized deduction. Everyone who files a 1040 tax return will come across this decision. These deductions may lower taxable income. So how do you know how to calculate each one? Well, the standard deduction is a preset amount they can deduct from your taxable income. The itemized deduction is a sum of all qualified expenses you can elect to reduce your taxable income. The standard deduction amount varies by your filing status. Itemized deductions are typically expenses such as mortgage interest on your home, property taxes, medical bills, and charitable giving. There are many others, but this just named it. You cannot choose both standard deduction and itemized deduction. Beyond standard and itemized deductions, another consideration we recommend is charitable giving. One thing is to note about charitable giving is you can do more than just give cash to charity. You could choose to do appreciated assets. Remember, when we discuss long-term capital gains rates, you can donate those assets to charity instead of recognizing those gains upon a sale. This saves you from having to pay taxes on the long-term capital gains while also giving a deduction if you itemize your income tax return. In most cases, you elect to take the higher deduction. So the amount you plan on giving is something we recommend you consider when working with your CPA. While taxes may be a focus when deciding on what and how much to give, there are other considerations you may want to look at when it comes to charitable giving. I'll turn it over to Elizabeth, who leads our signature generosity client community to share.
Thanks, Spencer. So in this portion of the video, we'll discuss some reasons people tend to donate, what a donor-advised fund is, and what you may want to look for in a nonprofit organization should you decide to contribute. So why is giving important, and why should you start thinking about it now? Giving is actually good for you, for both your financial well-being and your overall health. So from the tax benefits perspective, as Spencer mentioned, depending on your tax bracket and the amount of giving you are doing to public charities, you can potentially lower your taxable income via a charitable tax deduction. In order to claim that tax deduction, you must itemize your charitable gifts, which means you need to keep track of all of those receipts each time you make a gift, unless you're using a donor-advised fund, and a little bit more on that later. The amount of charitable donations you can deduct may range from 20% to 60% of your adjusted gross income, or AGI. By offering the opportunity for charitable tax deductions, the government encourages citizens to support our robust nonprofit sector. Nonprofits oftentimes provide the same services that the government might do, like housing, food, and other social services. Now, how can giving benefit your overall health? In 2014, a group of Notre Dame researchers published a book called The Paradox of Generosity. The book outlines some of the numerous ways that giving informs both big and small positively impact our health. They found that those who give regularly, whether financially, through volunteering, or even just general acts of kindness, had healthier, longer lives with lower rates of chronic disease and depression than those who did not. Plus, more recently, the U.S. Surgeon General declared an epidemic of loneliness in the U.S., citing social isolation as one of the most dangerous threats to our society. In his report, he specifically notes that generosity is a key way to alleviate loneliness and isolation by connecting with others in need. Now, how can a donor-advised fund be your best tool for giving? A donor-advised fund is a charitable investment account for the sole purpose of supporting charitable organizations. And you may hear me refer to it as a DAF through the rest of this video. You can generally open a donor-advised fund with any amount and with almost any type of asset: cash, stocks, cryptocurrency, real estate, almost anything. Many people use platforms like Schwab Charitable, Fidelity Shareable, or their local community foundation. You can then invest those assets so they grow over time, and you ultimately have more to give to charity whenever you're ready to start making grants. Or alternatively, you can start making grants right away. Once assets are placed in a DAF, you may not retrieve them. They are permanently dedicated to supporting the nonprofit organizations of your choice. You will receive the tax deduction at the outset when you place the assets into the DAF. In our perspective, and maybe best of all, having a DAF keeps everything super simple. You can track all of your giving online or even in an app, and rarely have to worry about itemizing your gifts or keeping track of receipts. All of the money you've designated for charitable giving can usually flow through this one centralized account. Now for the fun part, the actual giving. What should you be looking for in nonprofits as you start making gifts? There are nearly 2 million registered nonprofits in the US, so it can understandably be difficult to find the right ones to give to. First, we recommend identifying your own unique values and passions and looking for organizations and groups that align with those. Next, here are some key things to look for when researching. And you can do this research easily online and for free with the tool charitynavigator.org. So some questions to think about. How long has the organization been in existence? Does it have a board of directors? What is its operating budget? Where does its financial support come from? And are there ways to get involved as a volunteer beyond just financial support? Thank you for joining this session of our Wealth Planning 101 video series. We hope this has been helpful for you to understand some of the nuances of taxes and learn ways you can optimize your tax situation while also supporting the causes that you care about.
And not to mention the potential benefits to your financial well-being, your overall health, and your community. We look forward to sharing more tips and information with you in the future. Take care and enjoy the journey towards your net worth wealth.